Welcome to our video, 7 Proven Money Rules I Wish I Learned in My 30s. Today, we delve into a topic that holds immense importance in our lives, financial literacy. In this constantly evolving world, understanding the intricacies of money management and investment strategies is not just an option, but a necessity. We'll be exploring 7 pivotal rules that can steer you towards financial prosperity. So, gear up to embark on this enlightening journey. This presentation is brought to you by Higgins Capital, San Diego's fiduciary financial advisor. The first rule is, know thyself. It sounds simple, doesn't it? But it's the cornerstone of successful investing. This isn't about introspection or philosophy. It's about understanding your own financial landscape. It's about discerning your risk tolerance. Can you stomach the roller coaster ride of the stock market, or do you prefer the steady climb of a fixed income? It's about defining your investment timeline. Are you saving for a house in 5 years, or for retirement in 20? And it's about setting clear financial goals. Do you want to grow your wealth, or are you seeking to preserve what you have? These are the questions you need to answer before you make your first trade. And as your life changes, your answers might change too. That's okay, as long as you keep asking the questions. Knowing yourself is the first step in successful investing. The second rule is, diversify, diversify, diversify. Imagine you're at a buffet. You wouldn't fill your plate with just one type of food, right? The same principle applies to investing. Diversification spreads your investments across various asset classes, sectors, and geographic locations. It's a strategy to mitigate risk. If one investment doesn't perform well, others might. So, even if the tech sector takes a hit, your investments in healthcare or manufacturing could soften the blow. Consider a diverse mix of stocks, bonds, and perhaps commodities or real estate. A well-rounded portfolio is like a balanced meal. It's not just about having different investments, but about having the right mix that aligns with your risk tolerance and financial goals. But remember, diversification isn't a one-time thing. It's an ongoing process. You need to periodically review and rebalance your portfolio, adjusting the mix as market conditions change and your financial goals evolve. By diversifying, you reduce the risk of losing all your investment. The third rule is, time is your ally. When it comes to investing, time truly is a friend, not a foe. It's all about compounding interest, a powerful force that Albert Einstein once referred to as the 8th wonder of the world. Here's how it works. When you invest money, you earn interest on your initial investment. Then in the next period, you earn interest on both your original amount and the interest you've already earned. This process repeats and accelerates over time, hence the term compounding. The key is to start investing as early as possible. The earlier you start, the more time your money has to grow and compound. It's like planting a tree. The sooner you plant the seed, the more time it has to grow into a sturdy, fruitful tree. So remember, the longer you stay in the market, the more compounding interest works its magic. The fourth rule is, control what you can, ignore the rest. In the world of investing, there's an overwhelming amount of information, much of which is beyond our control. The economy's state, market fluctuations, global events, these are all out of an individual investor's hands, but here's the thing, you don't need to control them. What you can and should control are your personal investing decisions. Your asset allocation, for instance, is something you can steer. Are you diversified across different types of investments? Are you balanced between high-risk and lower-risk assets? Your savings rate is another factor under your control. Are you consistently setting aside money for investing? These are aspects you can directly influence. By focusing on these controllable factors, you build a solid foundation for your investment journey, regardless of the market's whims. Remember, it's about playing the long game. Focus on what you can control and let go of the things you can't. The fifth rule is, don't fight the Fed, and the sixth rule is, fear is your enemy, greed is your downfall. These 2 rules highlight the importance of understanding the broader economic environment and managing our emotions in the world of investing. In the grand scheme of things, central bank policies and interest rates play a substantial role in the performance of the financial markets. When the Federal Reserve, or the Fed, adjusts these policies, it can trigger significant market movements. This is why the rule, don't fight the Fed, is so crucial. It reminds us that, as investors, we must stay informed and adapt our strategies in response to these macroeconomic changes. But while understanding the economic landscape is important, managing our emotions is just as crucial. This brings us to the 6th rule, fear is your enemy, greed is your downfall. In the face of market volatility, fear can be a powerful enemy. It can lead us to make rash decisions like panic selling during downturns. On the other hand, greed can be equally destructive. It can lure us into chasing hot trends or making risky investments in the hope of quick profits. The truth is, the market will always have its ups and downs. It's the nature of the beast. But if we let our emotions dictate our actions, we risk turning these market fluctuations into personal financial losses. That's why it's so important to stay level-headed and make rational decisions based on sound investment principles, not emotions. In the world of investing, fear and greed are two sides of the same coin. They can cloud our judgment, derail our investment strategies, and ultimately lead to our downfall. By acknowledging these emotions and learning to manage them, we can stay on track and make more prudent investment decisions. To wrap it up, remember this. Successful investing is not about predicting the market's every move or letting our emotions get the best of us. It's about understanding the economic environment, sticking to our investment plan, and making informed decisions. Successful investing requires prudence, not fear or greed. The seventh rule is, learn from every trade, win or lose. This rule emphasizes the importance of viewing each investment as a learning opportunity rather than a simple win or loss. Just as a chess player studies their past games to improve their strategy, an investor should dissect each trade to understand what worked and what didn't. Did the investment perform as expected? If not, why? Was the initial analysis flawed, or were there unforeseen changes in the market? Each trade is a case study in decision-making under uncertainty, and every outcome, whether positive or negative, yields valuable insights. To be sure, it's easy to celebrate the wins and lament the losses. But the true value of an investment isn't just in its monetary return, it's in the lessons learned that can guide future decisions. So remember, every investment, win or lose, provides valuable lessons for future trades. In conclusion, these 7 time-proven rules encapsulate the essence of successful investing. From the significance of knowing oneself to the importance of diversification, time being an ally, controlling what's within our grasp, respecting the Federal Reserve's influence, managing our fears and greed, and learning from each investment decision, these principles are essential. They're not just rules, they're the pillars of a sound investment strategy. They serve as a compass, guiding investors through the complexities of the financial markets. Thank you for watching.